the type of income called dividends. Before we take a look at how dividends are taxed, let's learn an overall concept of what the dividend income is. So let's say that you want to invest to make money. So you're going to buy shares of stock in a corporation. So you're going to be a shareholder owning shares of stock in a corporation. So you would go through a broker and buy shares of stock, or maybe you can even go directly to the corporation to buy shares of stock. And eventually, you want that value of the stock to increase. And when you sell it, you get a sales price and you minus out the cost you had paid for that stock to get a gain, hopefully not a loss. We'll learn about how gains are taxed at the end of the semester. But another means of earning income from owning shares of stock is that most corporations may pay a dividend back to the shareholder. Sometimes it may be quarterly, 4 times a year, or maybe once a year. So we're focusing on this dividend income here, how it's taxed. In fact, it may be taxed the same way as how gains, net gains are taxed on investment sales. So let's say you're investing right now in just one corporation. So you may need to diversify by buying another corporate stock. In case something goes bad with one corporation, one of your investments, you still have other investments. A faster or maybe more efficient way of owning shares of stock of corporations is not to buy from individual companies or individual corporate shares, but to own shares in what we call a mutual fund or exchange traded fund. So again, you're the shareholder and you're buying shares not directly in from a corporation, but from this organization called a mutual fund or exchange traded fund. And in turn, that mutual fund or exchange traded fund would buy shares of stock, probably dozens of different corporations, to so-called diversify the investment. And likewise, this corporations below may pay dividends back to the mutual fund, paying distributions. And in turn, that mutual fund and exchange traded fund will pay back the shareholder that dividend income. Okay. Sometimes dividends are reinvested by the shareholder to buy more shares of stock. That dividend is still taxable to the shareholder. Likewise, for individual corporations, the shareholder may buy shares of that stock. Sometimes we call it dividend reinvestment program or DRIPS. Yeah. You still have to recognize the dividend as taxable, even though it's being kept by the corporation or being kept by the mutual fund. Going back to the mutual fund may also sell stock, the underlying stock. And if that's the case, the gain may also be distributed to the shareholder. Sometimes we call that a capital gain distribution, just like a dividend distribution. So these dividends are reported as income to the shareholder on a form called a 1099 DIV. And there's lots of different boxes here. The two main boxes is this one called ordinary dividends. Basically, that's all of the dividends being distributed by the corporation, this paying corporation, to this recipient taxpayer during the year. Included in this ordinary dividend is qualified dividends. All qualified dividends are also ordinary dividends. It depends upon the type of income received by the corporation, but most times the number you see here in box 1A would be the same as 1B. Now, the main difference is that you get taxed on all these ordinary dividends, but if they also include qualified dividends, that qualified dividends are going to be taxed at a lower rate. We'll see the basic calculation in a minute. Another box you need to be aware of is this one here in line 2A. Remember that capital gain distribution I talked about? If the underlying mutual fund or exchange traded fund sells the stock, that gain is going to be distributed back to the shareholder. So that's reported here in box 2A. Sometimes the corporation may pay out dividends that are not going to be taxable to the shareholder. It's just recovering the cost they had invested. Let's again go back to the scratch paper here. This cost right here. And once you use up all the costs, that leaves less or zero cost when you make a sale. Okay, but that would be tax-free if you still have costs being recovered in this non-dividend distribution. So I think that's the most common boxes used on this 1099 DIV form. Now, if the dividends total more than $1,500 for the year, this ordinary dividends, we need to fill in this Schedule B that we had seen previously when we were summarizing the interest income here in Part 1 of that Schedule B. But now for dividend income, we would use this Part 2. Notice the term ordinary. Remember again, included in ordinary is the qualified dividends also. So you would write out the name of the corporation or exchange traded fund and then the dollar amount. And then the next 1099 DIV, ordinary dividend, and the dollar amount. And you take a total here at the bottom that you carry back to Form 1040 in line, the right-hand column 3B. Again, if you're filling out this form because you have more than $1,500 of either interest or dividend income, you got to finish off this Part 3, indicating whether you have foreign accounts. In all the problems we have this semester, you're not going to have any foreign accounts. Yeah? So make sure you check off no, or in most tax softwares, the default is going to be no. So let's trace this total back to the 1040 form. So in line 3B would be the ordinary dividends that you had subtotaled on that Schedule B. But going off to the right, here in 3A, would be the qualified dividends. Again, let's go back to the 1099 form. The ordinary dividends in that right-hand column of the 1040 form, and the qualified dividends in the left-hand column. And again, when you eventually figure out your taxes, don't double up the amounts, because this amount here, qualified dividends, is already included in the ordinary dividends. I've seen students add up this dividend and this dividend to get the total down here. Okay, you're double counting the same income. So let's learn here briefly how qualified dividends are taxed. Again, let's go back to our, well, keep in mind that this dividend here is going to be added into total income and eventually adjusted gross income, and then the very bottom down here, taxable income. And we've learned already how to calculate the tax on the taxable income amount. Back in the previous chapter, we saw the tax tables and the tax rate schedule. So again, let's take a look at the calculation for tax on dividends. So let's start off with the taxable income number. Again, that's the number at the bottom of the front page. Let's do that just to remind ourselves again. So here's the 1040 form. So here's taxable income at the very bottom. And included in that taxable income is ordinary dividends, including the qualified dividends. Yeah? Okay, so our starting point in this calculation for taxing dividends is to start off with taxable income. Then what we're going to do is back out the qualified dividends. Remember that amount in the left-hand column? Again, this is already included in here through the ordinary dividend amount. Most times the ordinary dividend and the qualified dividend is going to be the same. Sometimes slightly different. If it is different, the qualified dividend amount is going to be smaller than the ordinary dividend. Okay, so we're going to subtract out that qualified dividend from the taxable income. And let's just call this taxable income without qualified dividend. Okay, just the difference. Now what we're going to do is tax this qualified dividend either at 0% or for most people 15% or for the very rich people 20% to get a tax on the dividend. And then the rest of the income in this taxable income without qualified dividend, we're going to tax it the same way that we had learned back in chapter 2, either using the tax table or the tax rate schedule to figure out we call it regular tax. And then we add up the two amount of taxes to get the total tax for the year, the tax liability. These rates here, taxing the qualified dividend, is going to be lower. It's going to be lower than the tax on the regular rates. Remember there was different tax brackets? Well, the tax brackets here are lower than the regular tax bracket. So you're saving taxes if you have qualified dividends. Also, if you have what we call long-term capital gains, again, eventually if you sell your investments over here and you held the asset for more than 1 year and you end up with a net amount of gains, this gain will also be taxed at low rates. Low rates like the qualified dividends. Okay, so our textbook goes through a calculation of how to do this this tax, but the way I want you to do it is to use the worksheet. So I have it linked in our chapter 3 resources folder. Let's see if I can pull it up here. On page 33, qualified dividend. Again, that's what we're working with here. And capital gains, a topic we'll learn by the end of the semester. So what we're going to do is, here you can see this line 11b. This is your taxable income here from the 1040 form. And we're going to back it out. And depending upon the total taxable income, if it falls within certain ranges, for example here, if you're single and your taxable income is under $39,375, your tax on the qualified dividend is going to be 0%. And if you're married filing jointly and your taxable income is this amount here or less, the tax on the qualified dividend is 0%. And then the rest of your income you would look up on the rest of the non-dividend income would be looked up on the tax table or tax rate schedule. Now, if you're wealthy, make a lot of money during the year, and you're single filing status, and you make more than this amount, your qualified dividends, not ordinary, but again, the qualified dividend, going to be taxed at 20%. Married filing joint, if you make more than this, your qualified dividend taxed at 20%. Now, based upon your filing status here and here, and you see the difference in the amounts that range, for most people, their qualified dividend gets taxed at 15%. And again, the rest of the income is taxed using the tax rates, tax table or tax rate schedule. Again, it's being calculated here on this worksheet. Here it says you keep for your records. You don't turn it in with your tax return.